This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
This is Joe. So I'm going to give you a way to navigate longer term investing, especially with all the volatility. It can get pretty unnerving if you're trying to play long term. So I'm going to give you a few ideas. These aren't hard and fast. You can play with these ideas and maybe make them your own. But I'm going to give you a suggestion that I think is a pretty solid structural plan. All right. And then you can maneuver things a little bit to maybe fit your personality. I'm using something that fits my personality. So let's go ahead and get going with this. Now, if you do want to learn more about some of these techniques, I would suggest starting with my book. You can click the link to find more information. If you do enjoy this content, please hit the like button and also subscribe. Okay, so I have a unique little setup here in Thinkorswim. And what I've done, and I'm going to actually go into this and show you that it's a multiple time frame average true range, basically acting as a trailing stop. So I like to use 2 times the average, 2 times the ATR as a stop point. Now, I don't like this necessarily just to trade individual stocks. I don't think it's quite as attractive. There are some false signals, but when we start to look at it from a longer term standpoint, especially when I'm looking at something like the Spider or the QQQ or IWM, something like that, I think this can be a really good way in your 401k to stay in line with the market, but not take the market risk. All right. Now, here's the strategy, the way I would suggest doing it. Now, again, as I stated in the intro, you can kind of move this around a little bit. It doesn't have to be an exact, the way I'm portraying it has to be exactly the way you're going to do it. But I think it gives a pretty good framework for you. So what we've got here are, I've got the monthly average true range. So I'm looking at a weekly chart, all right? And the small dots are the average true range on a weekly basis, all right? So if I look at this, let me get into this study. It's a weekly ATR with using the 2 as the multiplier and 20 as the look back period. So it's a 20 period ATR and it's 2 times that. It's the Wilder's version of average true range. All right. So what we're doing here is we're going to use the average true range as like a buy and sell signal on the weekly chart when the monthly chart is bullish. All right. Now what you can do is keep a portion of the money. You can keep a portion of the money invested. All right. And then trade around another portion of the money. All right. Hopefully this will make sense to you as we look at this a little bit deeper. Now, let's just look at this going back to 2020. We had this harsh move to the downside and you would have gotten completely stopped out of your positions. And it would have been a late signal if you're using the monthly. But if you took the weekly signal, you would have been out on this big bar here and you wouldn't have gotten it off, in this drop. But then it gets back above the monthly, the average true range on the monthly trailing stop right about May of 2021. All right. I'm sorry, of 2020. You would have gotten out and then gotten pretty much right back in a few months later. All right. Now, if you notice what took place, price stayed above both of these lines on a weekly closing basis all the way through to the peak in the 2022. And then you would have taken out half of your position on the break of the weekly line, the weekly average true range. All right. And then a little bit later, you would have broken the monthly line and then you would have been out for the rest of the bear market. Now, I want to point something out because I have the ADX below. And for those of you who want to be a little bit more active with it, the way you could play this is that as this is moving up, we're playing this fully, no problem. But then as we see the divergence taking place in the average true range, we wait for our weekly close below, but then we would take out the whole position based on what the ADX is doing. All right. In other words, you're going to be a lot more aggressive when there's loss of momentum. You could also use the market conditions that I put out, each week. And when the market conditions are not in a solid position, there's higher volatility and low trend strength, then you could look to be a lot more aggressive seller as we break the weekly line. Now, I wouldn't just do it on the way up, I would make it take out a weekly closing line. We don't know how long this is going to signal go before a signal takes place. All right. And then if you follow this along, we stay out all the way through until it gets back in May again of 2023. It kicks back in, and then you would have been in for a little while. You would have taken out half the position as it broke the weekly, but stayed above on the monthly, and then you would have gotten long again in November, and you would have stayed long until April of the next year. Now, keep in mind, you still have 50% of your position invested. The other half would be trading around this weekly position. Now, that can be a very protective. I can act as a very protective tool by taking out the weeklies, so that you don't have any real huge risk waiting for the monthly. Now, again, there's different ways to do this. The way you could do it is, as long as the ADX is strong, you ignore all the little minor signals, the weekly signals, until we get a divergence sign or a sign of weakness in the momentum. All right. Now, you're welcome to do that. You can just stay long until the monthly breaks. If you would have done that, you would have gotten in here in June, right? Because we've had nothing but strong signals up until this point up here. You would have pretty much stayed long, and then you would have basically taken some profits in this arena here, around this area here, and then you would have probably gotten back in as it recrossed back above here without breaking it on the monthly chart. So these are the ways. I don't know. I mean, look. All I'm doing is looking at these average true ranges on a monthly basis and on a weekly basis to determine whether the trend is intact or not. Let me just show you something like the QQQ. You could have done the same thing. It basically laid out in a very similar fashion. This was a bend but not break signal. It went all the way down, but it never closed below the monthly level on a monthly closing basis, right? So again, there's different ways to do it. You can use the ADX to really help you stay in tune with what the momentum is telling us. Same sort of signal developed here. You would have probably wanted to use the weekly sell signal and then stayed away until the monthly clicked back in again. So, this is not the type of thing where I would do on individual stocks, but I think this can be a great way to participate without taking the big risk. I mean, if you look at these going back, and especially through periods where you have a very strong market condition, you're going to be fully long through the whole period. All right, that happens, I would say pretty regularly on the major indices. We'll see that time and time again, where you'll be, for the best part of the move, you're going to be fully invested. And then when it starts to get a little squirrely, you might be kind of swinging in and out on the weekly chart, but still holding on a monthly basis. All right, it's really difficult to get the bigger picture to really break. Let me show you the S&P going back historically. Now, just to make it clear to you what the monthly is doing, I'm going to use a 20-year monthly, and to show you, this is the monthly chart with the monthly trailing stop. Okay, so you can see what happened this month. It came all the way down, and by the end of the month, it came back. So that's why this was not interrupted. And if you use that, you're going to catch all bull market moves. You're just not going to miss anything. You'll be out during severe bear markets. All right, you can see what happened in 2007, 2008. It broke here in early 08. And would have kept you out for the entire bear market, and then you would have gotten back in July of 2009 and got started again. Then you'd have been stopped out with a small profit there, decent profit actually. If we look at the price, it would have been $9.45 in the S&P and stopped out around $11.75. And then you'd have gotten back in February. Okay, and of the following year of 2012, you'd have gotten back in, caught a really nice move, and then during 15 and 16, you would have been out while it was doing nothing. Again, catch another pretty big solid move, and then in 2019, you would have been whipped around a little bit, been whipped around in 2020, but then catch the lion's share of the move. Now, I'm saying you're getting whipped around a little bit, but what you're doing is avoiding bear markets, all right? The goal of this whole thing is to have you to participate in a move, but not take risk on a bear market for a big move and a decline on a bear market. If someone's in their 50s and they want to participate in the market and have their money grow, but they don't want to take the risk of having something getting drilled down and being down 20 or 30%, taking your money and being down 20 to 30% in any single year or 2-year period, that's really hard to do if you're 56, 57, or 60 years old and you go through that kind of a bear market. Now you're in a very difficult position, because to make that back, you have to have several years of upside to really make up that difference. All right. So I hope all this makes sense to you. Now, I know the questions I'm going to get is, why can't I just do this on individual stocks? Just click me in, click me out. And I can do this on trading plays, intraday, short term, and all that. I mean, you could do it, but I'm just telling you, the signals are not as good as what I am teaching. I know that there's a lot of false signals. If you put them side by side, you will see that half the time they're a little bit on the early side. And if you want to try and apply the teachings that I've had in the courses and in the book to these, you can do that. But what I'm trying to create here or help you with is having a hands-off version of a long-term investing strategy that allows for you to account for volatility, right? If you account for volatility for whatever you're playing and you give it enough room from that standpoint, you can allow something to trend. And that's the goal. We're trying to get in and stay in as long as there's a trend in place. When the volatility grows, you should be stopped out. That's typically a sign of a reversal is coming in a lot of cases, all right? Now, we're using the ADX to really help us with this from a momentum standpoint, which should give us some leading indications, all right? Hopefully, this all makes sense to you. So we're trying to be long-term trend followers, accounting for volatility and accounting for momentum. All right. So we're using momentum in our favor. We're accounting for volatility, and we're letting these things play out as a long-term trend follower. I call it trend following on steroids, because you've got momentum in your favor and volatility allowing enough room. All right. So that's how I would look at this. Let me know if you have any questions. Thanks. Or you can click the link in the description to find out more about some of these techniques. Have a great trading day.